All right, welcome back to another market update for you. Today is Monday, April 25th, 2022, and there's a lot going on, so let's get right into it. Starting with our first market updates earlier this year, the theme was Not So Happy New Year, with stocks down and bonds down. And since that time, both major asset classes have continued trending down, making 2022 still not a very happy year for investors. The 6 or 7 headwinds we started the year with are still front and center. The Fed beginning a rate hiking cycle, high and probably more persistent inflation than many market participants had anticipated, Fed balance sheet reduction, the war in Ukraine, supply chain issues, and a relatively expensive stock market.
And just look at what that cumulative effect has done to asset prices this year. All major US stock market indexes are down more than 10% for the year, almost back down to their lows for the year. But keep in mind the tech-heavy NASDAQ and the small-cap Russell 2000 peaked last year. So their drawdowns from their one-year highs are even deeper. And again, we see that a lot of carnage has taken place beneath the surface, with the average stock within each of these indexes having drawn down from a quarter of its value to down by almost half.
But not only that, bonds, which we typically use as a diversifier for stocks, meaning when stocks go down, we've historically relied on bonds to not go down, at least not go down nearly as much. Well, look at core bond values this year. 20-year treasuries, yes, those risk-free treasuries, are down almost as much as the NASDAQ this year. Intermediate treasuries are down almost as much as the S&P 500. And even sleepy old municipal bonds are down 7.5% for the year. With stock and bonds both down, that begs the question, what is the role of bonds in a balanced, diversified portfolio? Are bonds done? Well, we're currently conducting a research project to address this very issue and look forward to sharing the results with you. However, for the time being, a couple points to keep in mind. We are currently in the 5th worst drawdown as measured by 10-year treasuries since 1954. That's almost 70 years. And what happens next over the next 6 months for these drawdowns? More often than not, bonds bounce back, with relatively few instances of continued severe drawdowns. For example, this average here is a 4.9% gain over the next 6 months.
All right, most asset prices are down across the board. But isn't this what the Fed wanted? To cool off the economy, to make folks less excited to spend, which would hopefully lower inflation. So here we are looking at GDP growth estimates for Q1 in blue, all the way down to 1%. The actual data comes out this Thursday, April 28th, so we'll see. Then the market's attention will shift to Q2, the orange line here. The main point here is that GDP growth estimates are coming down, as well as stock market earnings growth estimates. Slowing economic growth, slowing earnings growth. Sounds like the Fed's wish was granted.
Maybe so. Let's look at inflation, which we all know has been screaming higher. But let's go beyond the doom and gloom headlines and consider, could inflation actually be thawing? First up, cars and trucks. We all know this story well. Just 2 months ago, the price of a used car was up 45% year over year. But the past 2 months, it has come down to only 24.8%. Next up, not all inflation is equal. The Atlanta Federal Reserve breaks inflation down into sticky and flexible. As the name would suggest, sticky inflation is a weighted basket of items that change price relatively slowly. Things like motor vehicle fees, education, public transportation, and motor vehicle insurance. Whereas flexible inflation contains things that move more often, like motor fuel, apparel, dairy, and jewelry. As we see here, during the 1970s, we saw both sticky and flexible core inflation soar. But so far, only flexible core inflation has moved significantly higher during the bout of inflation. Could this mean that flexible inflation could come back down just as quickly? The final reason inflation could be near a major peak is the major backlogs we've seen at various ports is finally thawing. The ports of Los Angeles In Long Beach, backlogs are nearing September 2021 levels, while the cost of shipping is also coming down, and very quickly. In fact, shipping rates from Shanghai to LA, New York, or Rotterdam are down 28% on average from the peak last year. Shipping rates were between $1,000 and $3,000 pre-pandemic. So there could be a long ways for this to continue to fall, and it won't happen overnight. But this is another very positive clue that inflation could be nearing a major peak.
Whether it's inflation or interest rates or falling asset prices, a feature of markets and investing is for things to overshoot in either direction. It's as old as time, and it will continue forever. And we're not perfect either, but we always try to put things in perspective, as we believe that gives us the best shot at achieving long-term outcomes. The number of Fed rate hikes, we've been talking about this in our videos since the beginning of the year. First it was 4 hikes this year, then 5, then 7, and now we're almost at 10 Fed rate hikes are priced in. Could it happen? Anything is possible, but we believe the Fed is well aware of the effect such an aggressive hiking cycle would have on markets and the economy, especially, as Chad mentioned, if things like inflation are beginning to thaw. Intra-year declines. All these red dots are how far the S&P 500 went down during each calendar year, and the gray bar is where it finished the year. So just about every year has drawdowns, and more often than not, the market still finishes higher. But still, drawdowns can feel uncomfortable. Here we are through March 31st with what historically appears to be a very average intra-year decline. But with such a tough year so far, and so much uncertainty still out there, it's only natural for consumer confidence to be beaten down pretty good. And look at this, a lot lower than the COVID low and knocking on the door of GFC global financial crisis. But the most interesting part of this chart are these percentages. These are the next 12-month returns for the S&P 500 when consumer confidence are at these levels. So again, it doesn't feel good to be investing in the face of so much uncertainty, especially when both stock and bond markets have sold off this year. But it's often when things don't feel great that the best forward returns are available to us.
And on that note, we'll go ahead and wrap up today's market update. As investors, we want uncertainties to resolve immediately, but unfortunately, that's just not how markets work. We'll continue keeping an eye on all these moving parts, and we'll keep you informed as things change. Thank you very much and have a great day.